The stock market has always gone up historically, but somewhere between 80 and 90% of traders lose money in the stock market. What's going on here? What's up everybody, I am Jaspreet Singh from theMinorityMindset.com and welcome to The Minority Mindset. I'm sure you know that the stock market is a wealth building tool, but many people are scared to invest their money in the market because they don't want to lose money. I mean, there's story after story of people losing money in the stock market, and there's probably more articles on the internet of people talking about how to manage your losses and manage your risks instead of actually making money. If you're a rational minded person and you hear of all these people making money in the stock market, you might be confused. Why are so many people losing money in the stock market if the stock market goes up? I mean, take a look at this historical chart of the stock market, which shows the stock market over the last 30 years. We've seen dips, we've seen crashes, but we've also seen the stock market way higher now than it was 30 years ago. Well, it's not so simple. And if you've ever invested your money in the stock market, you understand that successfully investing in stocks isn't as simple as those people on Facebook ads with the fancy cars keep saying it is. Today, I want to go over some of the big reasons why people lose money in the stock market and some of the common mistakes that you should avoid. But before we get into that, I need you to do me a big favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. The first and most common reason why people lose money in the stock market is because they are trading, not investing. There is a way to make money as an investor and as a trader, but a lot of people come into the stock market thinking they're investing when they're actually just trading. A stock market investor is a person who buys stocks and plans to hold on to their investment for at least a year. A stock market trader is somebody who buys stocks with the goal of selling them quicker than a year. The longer you own an investment, the better chance you have to make money on it. In 1973, a Princeton University professor took 100 monkeys and he blindfolded them and he gave them darts to throw at a financial newspaper, because when they threw darts, they would land on a random stock, and then he wanted to see how these stocks would perform over the long run, because his theory was that you don't need to be a rocket scientist to be a successful investor, because these random monkeys who are throwing darts blindfolded at these financial newspapers and financial stocks, he thought that over the long run, these monkeys would be able to beat the average person, and he actually thought that they would be able to do just as good as the experts. Well, this Princeton professor was wrong. Not only did the monkeys beat the ordinary people, but they also beat the experts. The reason the monkeys did so good in the stock market is because, well, they didn't know what they were doing, so they didn't feel pressured to sell. All they did was throw darts at a newspaper. They didn't have to listen to the news talking about how the economy is going to crash, and they didn't have to sit there and watch their portfolio hover up and down. Over the long run, our economy has always gone up. That doesn't mean it has to be a straight upward trajectory, but it does go up over the long run, and that helps stock prices go up too. Now, this doesn't mean that every stock is always going to go up. I mean, if your company is on the verge of bankruptcy or failure, then your stock's going to go down. But growth in the economy and the stock market takes time. If your goal is to make money in the stock market tomorrow or next week or next month or this year, then you don't have that much time for your stock to grow because you're trading. In the short term, the stock market is emotional, and anything can trigger the stock market, even a tweet from a celebrity, because it's emotional. This puts traders at a higher risk of losing money because you're trying to make money in a short time span. But if you just increase your investment time span, now you're giving your company more opportunity and more time to make more money and grow, which gives the stock more opportunity to grow as well, assuming that your company doesn't go bankrupt. And this brings me to number 2. Understand the media. I used to say ignore the media, but you probably want to know what's going on in the world, so it's better for you to understand what the media is actually trying to say. Let me give you a quick YouTube class on how to understand what the media is saying. When you hear the media say, "Good evening, viewers. Wow, the stock market is soaring and it looks like it cannot come down," what they really mean to say is, "Hello, the stock market is going up quite a bit, which means the original investors who invested early are getting rich, and now all these new investors who are investing because they have the fear of missing out, FOMO, are about to get burned and lose a lot of money." When the media says, "Good evening, friends. Today I have some somber news because the stock market is crashing and we don't know what's lying in our future," what they really mean is, "Good evening, you random viewers. The stock market is very cheap right now because people are panicking and they're selling their stocks. But if you believe in our economy and our stock market for the long term, this is a great opportunity for you to come in and buy." high. And when the media says, "Good day, my lovely viewers, our next guest is here to tell you why they think you should be selling all of your stocks, that way you can buy coconuts," stay tuned. What they really mean is, "Hi, I don't know what time of day it is, but I found somebody who has a very polarizing opinion which will help our ratings because you hopefully are gonna get triggered and tell your friends to watch my crazy shit." Look, the media is not in the education business. Chances are, if the media is already reporting on a stock rally, chances are you missed that rally. Remember, if you're an investor, you're investing for the long term. These short-term dips and rallies don't mean anything. Your goal is to see your company grow and make more money over the long term. So you don't need to pay attention to the day-to-day media hype. If your company is having serious fundamental issues, that's a different story, but every company is gonna have good and bad news. You need to be able to read through the lines, that way you can actually understand what's being said. Third, invest the right way. Investing has risks. You are never guaranteed to make money when you invest. You might even lose money, so always do your own due diligence and never blindly listen to a random guy on YouTube. Who you calling random? And here's another one to add to the list. Never invest more than you are willing to lose. Margin trading is when you turn your $1 investment into $10 because you are trading with OPM, other people's money. You are borrowing money to invest in stocks. Investing in stocks is risky. You can lose your money, and if you just lose your own money, that's one thing, it's bad enough. But if you're losing somebody else's money because you're trading on margin, now it's an even bigger problem. You can get sucked into a downward spiral of debt because you're trading money without knowing what you're doing, using somebody else's money, and now not only do you lose your own money, you lose somebody else's money, and you have to pay that back plus interest. But you can avoid that mess by using your own money and not trading on margin. Now, if you do want to invest in stocks, you have to use a stock brokerage like our sponsor, Webull. Webull is a digital brokerage. They are super simple to use, and all you have to do is create a free account, fund it, and then you can buy or sell whatever stocks or ETFs you want right off of your phone or computer, and they don't charge you a penny to make a trade because they are a commission-free brokerage. And the best part of all is that for a limited time, we will up their promotion because now they are giving you 2 free stocks valued at up to $1,600 when you deposit $100 into your account when you use our link in the description below. To be fair, I don't know how long this 2 free stock promotion will last, so take advantage of it while you can. And Minority Mindset is a partner with Webull, so if you use them, we will get compensated, but there's no additional cost to you. They're free to create an account, they don't charge you a penny to make a trade, and they are giving you a free stock just for using them. So if you want to learn more and start investing, I got the link to how you can do that in the description below. The fourth thing that I want to talk about is that everybody thinks stock market investing is about picking stocks, but that's not true. And if you ask me, most people should actually not be in the stock picking game because people either cannot manage their emotions, they cannot manage their investments, or they do not want to do the research required to invest in stocks. But just because you shouldn't be picking stocks doesn't mean that you shouldn't be investing in the stock market. There's more than one way that you can invest in stocks. Everybody knows that you can invest in individual companies like Tesla, Netflix, and McDonald's. This is what stock picking is. But you can also invest in ETFs, which are groups of stocks. When you invest in individual companies, so Netflix, Tesla, McDonald's, now this requires more research and more work because you want to be actually researching these companies and make sure that they're strong and making money as you invest with them. And so it comes with more risk too, because if the company you invest in fails or has problems, now your whole investment goes down. When you invest in an ETF, which is a group of stocks, now you can get exposure to the entire stock market as a whole or a certain sector of stocks. If let's say you invest in an ETF like SPY or VOO, again, I'm not telling you what to invest in, just giving you examples. These 2 funds invest in the top 500 companies on the stock market. So if you invest and buy shares of SPY or VOO, now you're essentially getting exposure to the top 500 companies in the stock market without having to actually go out and buy all these 500 companies. Now, if the stock market goes up, your fund generally goes up. And if the stock market goes down, your fund generally goes down. You have ETFs for almost everything. I mean, you have ETFs for the general stock market, like I just talked about. You have ETFs for tech stocks, healthcare stocks, real estate stocks, growth stocks, dividend stocks. If you don't want to be in the business of researching and analyzing your investments, then the ETF way is a much better way to go because you lower your risk and you don't have to do all that. And this brings me to number 5. Make sure your goals align with your investments. Just like how there's more than one way that you can invest in stocks, there's more than one way that you can make money in stocks. Lots of people say that they want to make money in the stock market. But how do you want to actually make that money? And how quickly do you want to make that money before you sell? If you invest in a company and you see it go up 30, 40, 50%, do you know when to sell? If your stock is paying you a dividend, should you reinvest that dividend or should you spend it on something nice? You need to understand what your goal is and make sure your investing aligns with your goals. If your goal is passive income, you should be investing in dividend-paying stocks. And if you don't need that passive income right now, then you should be reinvesting that dividends. That way your dividends get bigger in the future. Do you want to see the returns that you want over the next 3 to 5 years, or do you want to see these returns last you until retirement? Companies like growth stocks come with higher risk, but you can get bigger returns in the short run, while companies like blue chips, your more stable companies, can give you those returns for the long run. Each one of your goals is going to come with a different strategy. If you're just buying stocks because you want to make money, then you're jumping into war without having a plan on how to fight. Start with the end in mind and then work backwards. That way you can create a plan. This is what financial education is all about. And if you're looking for more resources to up your financial education, we have a free ebook on money management and investing that you can read for free when you sign up for our financial education emails, which are also free. You can get a free ebook and start reading our financial education emails by clicking the link up here or by clicking the link in the description below. By the way, our financial education emails are separate from our financial news emails. Thank you for watching. If you enjoyed this video, share it with one friend. That way we can help spread the word. If you want to learn more about how you can make $1,000 a month through passive income using dividends in the stock market, I already made a video on this, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.